Made in America doesn't mean exactly what people think it means. Be a risk manager, not a prognosticator. The uncertainty is weighing on economic growth.
Do tariffs have a bigger impact on inflation or on growth?
That's a great question.
Welcome to The Call. I'm Jay Sapsford, and here's today's question of the moment. Can the U.S. avoid stagflation? The U.S. economy is showing signs of a slowdown at a time when inflationary pressures are making prices a bit sticky. The combination, slowing growth and elevated prices, amounts to a risk of stagflation and a tough situation for the Fed. Cut rates to fuel growth and you might make inflation worse, but leave rates elevated to restrain inflation and you might hurt growth and employment. The wild card? The uncertainty around tariffs. Will they fuel inflation, slow growth, or both? Joining us now to frame this moment in the economy and in the markets is Robert Kaplan, Vice Chairman at Goldman Sachs and former President and CEO of the Dallas Federal Reserve. Rob, welcome to the call.
Great to be with you. Thank you.
Let's start with the state of the U.S. economy. We were seeing some consumer sentiment is declining, but the recent prints suggest that the inflation has not filtered through to the broader economy, at least not yet. I wonder what your assessment is. What are you seeing now, and what is keeping?
There are 5 big structural changes going on in the United States, and we'll talk about those, I think, in the in some further questions. But what I'm seeing basically is a slowing economy. We expect stickier prices, but we haven't seen them yet. And the reason we expect stickier prices is due to tariffs. The 5 big structural changes are, number one, changes in the way we do fiscal spending, the desire to cut fiscal spending. That's where DOGE came from. Number 2, regulatory review across industries. Number 3, a desire to reduce the cost of gasoline through a restructuring of the energy ecosystem and encouraging more production. We're already seeing a lower energy price as a result. The 4th is a dramatic reduction in immigration and change in immigration policy. And the 5th is tariffs. That's a lot of changes going on at once. And I think the uncertainty of all these 5 at once is weighing to some extent on economic growth.
Now, Fed Chairman Jay Powell said this morning in his framework review, we may be entering a period of more frequent and potentially more persistent supply-side shocks. Is that linked with the structural changes that you were just talking about right now?
Yeah, I mean, we're used to a globally integrated supply chain, and companies have lots of options for how to construct their supply chains. Tariffs limit those options. And so the reason he's referring to supply shocks, if there's going to be a lot more tariff uncertainty, it may limit the choices of companies and may limit their ability to get supply.
How soon do you anticipate the impact of the tariffs might filter through? The prints that we've seen recently haven't really shown that much sign of elevated or inflation getting any worse from where it is right now.
Yeah, so people have to remember, because of the 90-day pause, with the exception of China, the tariffs haven't gone into effect yet. They've been delayed. The China escalation did go into effect, but this last weekend it just got rolled back. So we haven't seen the actual tariffs. We think we've seen pre-ordering and pre-buying by consumers and companies. And so the reason the Fed is cautious right now is we will see tariffs. We don't know the level. We would guess they're going to be on average in the mid-teens, but we don't know. And so they're sort of planning for something, and companies are planning for something, and consumers are planning for something that is still not yet clear.
Now, Rob, we're throwing up on the screen a map showing which states are most dependent on international trade, and Texas weighs in at 32%. You were president of the Dallas Fed in 2019, the last time we had a round of tariffs, and thus part of the decision to lower rates 3 times that year, calling it a mid-cycle adjustment. If the economy is slowing now, why can't the Fed today also get in front of the slowing economy and do another mid-cycle adjustment?
So just to take on the first point, yeah, Texas is a very large trading state. By the way, our largest trading partner is Mexico.
Right.
And this is why the relationship with Mexico and Canada for most U.S. manufacturers is very critical. Made in America doesn't mean exactly what people think it means. It may mean most of it is made or assembled in America, but you're likely using logistics and supply chains from Mexico and Canada. And so those relationships are very critical. The reason the Fed isn't able to preempt this slowing is we still have an inflation issue, meaning we're coming off the last 2 or 3 years where we've been bringing inflation from a high of 9% down to into the twos. The irony about this is goods have been disinflating. Goods inflation has not been the problem the last couple of years. It's been service sector inflation's been sticky in the mid threes. If we didn't have an inflation issue, I think the Fed would be more inclined to be preemptive and cut rates. But because we have still an inflation issue, not as bad as it was a couple of years ago, but still there, and we're about to have this cost shock from tariffs, there really can't, unless unemployment starts spiking, as long as unemployment stays well behaved, which it has so far, they really are wise to wait and understand how this cost shock is likely to feed through. So you'll see them shorten up their time horizon, take it one meeting at a time. But yeah, the inflation issue is keeping them from being more proactive.
Now, I imagine businesses will absorb some of those tariff increases from their profit margins, but they can't do that forever. At some point, this is going to filter through the broader economy, I would suspect. Am I wrong about that?
No, you're right about that. So here's the good news and here's the bad news. The good news is manufacturing is only 12% of the U.S. economy, and imports of goods is about another 12 or 13%. So that's a nice way of saying about 75% plus of the U.S. economy is services. So if goods prices go up, I might go out to dinner one more time instead of buying a good. Consumers have a great ability to adjust. And to your point, the other thing is suppliers, once these tariffs are set, might lower their prices. The dollar could strengthen. Companies might decide to take a little bit of the price increase cost out of their margin. And so some of it may find its way to consumer prices. And so I think it's pretty unpredictable and more dynamic than people may think about how much this actually feeds into inflation. And there's a lot of offsets that can help mitigate it.
So you're a former central banker. How do you manage a situation in which the dual mandate of stable prices and full employment are in conflict with one another? Classic stagflation, as we know it.
So in those situations, I believe you want to take a balanced approach. And so you look at how far off are we from our full employment target? And right now we're not off of it. We're at full employment. And then you look at how far off are we from our inflation target, and you say, okay, we're not there yet, and we're about to have a cost shock that might actually make inflation work. You look at both and you balance both. That's why I said if you saw unemployment begin to spike up and say, okay, boy, the increase in unemployment, we've got to raise the concern about that, and that concern might outweigh the stickiness of prices. That's the kind of balancing you're doing. Right now, the Fed doesn't have to do it because we're not seeing unemployment. We're seeing slow GDP growth, but it's not translating yet into higher unemployment. So the Fed can really bore in on the inflation concern. If things change, they might have to balance it more.
All right, one of our members is asking, do tariffs have a bigger impact on inflation or on growth?
Yeah, and that's a great question. Everything I've seen and all the research suggests they have an effect on both. Which effect is bigger depends on the size of the tariffs and how widespread they are. So, for example, in 18 and 19, we had a tariff issue primarily with China. It had some effect on growth, didn't have much effect on prices. Why is that? We only had a tariff issue with one country. Today, given the way we've rolled this out, we've actually created tariff issues with anywhere I look. For supply outside the US, I have a tariff issue. That makes the cost issue a little more likely. And it also, on the other hand, makes consumer slowing a little bit more likely. And so, which is greater, it's hard to say. But the fact that this is so broad, I think, is increasing the weighting of the management challenge here.
So the tariffs with China now seems to be settling somewhere around 30%. That's our third largest trading partner. We're talking hundreds of billions of dollars every year. That's got to have some sort of impact, even at 30%, even though it's down from the initial threats of 145 or what have you.
And it does, but the way companies have managed that in the past few years, they've done more in Vietnam. We've brought more to North America and used Mexico and Canada for logistics and supply chains. I'll be watching very, very carefully where we ultimately resolve with Mexico and Canada. Those are critical to having companies domicile more here with more confidence that they can be globally competitive. And countries like Vietnam, where that tariff settles out, also is a big issue, because that's been a go-to country if you weren't going to be in China. But right now, it's up in the air. And if I'm a company, I know I can domicile in the United States and not have a tariff, but that could take years. And also the costs here are higher than those other countries. So I'm unless I use excess technology I don't currently use, I'm a little reluctant to do it.
All right, here's a question from a member that I think speaks to the fact that you're speaking to your clients day in and day out. Do you think it likely that China will open access to control of its corporations to U.S. companies as a result of the negotiations currently underway?
I think I think it's likely that some of the trade barriers with China may be relaxed. That doesn't mean we're going to sell more goods there. So I'll give you an example. Vietnam is an example of this, has a GDP per capita of $4,000 a person. Remember, China's GDP per capita is much lower than the United States. There's a limit on what either economic or cultural, there are limits to how much those consumers are going to buy, even if there were no barriers. I lived in Japan for 5 years. The Japanese would far prefer to buy rice grown in Japan. They have very particular tastes. And we've been complaining, why won't they buy our rice? Well, it's not a tariff barrier issue. It's a consumer preference issue. And so yes, I think China will relax some restrictions. I don't think they'll go as far as control of Chinese companies, but they'll relax some restrictions. And I would think we'll make some progress there.
You raised Japan here. There's currently some talk of negotiations underway. Do you think the Japanese are going to let that 25% auto tariff stand, given all the investment? They've invested $750 billion in cumulative FDI in the United States. They're feeling like they don't get any credit for that. I wonder what your thoughts are on that.
Yeah, I think the Japanese are I used to live in Japan. They're frustrated.
Yeah.
One, they actually want to negotiate these tariffs down to zero. I think what they're learning is the U.S. is saying, no one's getting in this go around. No one's going to do better than 10%. So I think that's frustrating to the Japanese. Number one. Number two, they watched a de-escalation over the weekend with China, and they feel like they haven't gotten any tariff relief, and we're a very close trading partner. So yeah, there'll be progress on Japan. The thing that the Japanese are, I think, struggling to get comfortable with is that tariff won't go down to zero. They want it at zero. It's going to be at least 10%. And that's, I think, one of the reasons why we haven't seen more progress. I think we will see progress. We haven't seen more progress announced with Japan, at least as of today.
Shifting to the markets here, another member is asking, what is your assessment of the market volatility in recent weeks?
Well, the issue is the U.S. stock market is based on earnings multiples, is by historical standards pretty fully valued. We have a lot of uncertainty on trade. And in addition, when the probability of recession goes up, the assumption is in a recession, S&P earnings will go down something like 10%. As the probability of recession diminishes, I think this last weekend, a number of economists say the tail risk of a recession is less. I think people will have more confidence in S&P earnings. And that's why I think you've seen some firming in the stock market. But so they're not only dealing with these structural changes, which affect various industries in different ways, but also if their thought of recession is high, they're going to have to change their earnings forecast. And so there's been a lot on the plate of stock market investors. I think getting a recession probability off the table and diminished will be a big step forward in stabilizing the market.
Now, the recent turmoil, we had a situation in which the stock market was quite weak, but we didn't see the flight to quality to some of the long and fixed income products here in the United States. Is this a sign? There's been a lot of talk about the shine being off the dollar as the global reserve currency, as the currency of exchange. I wonder what your assessment is of that.
I think we shouldn't take for granted that people always have to be in the dollar. So let me be more specific. In times of stress, as you said, what we're accustomed to is dollar strengthens and the 10-year and the treasury market tends to rally. We're not seeing that as much in the last few months. And I think instead you've seen, in times of the market sold off, you've seen the dollar weaken, the 10-year be sticky, and gold rally. I do think investors around the world are not saying for the long run they want to be invested elsewhere, but some of them are saying from a defensive point of view, they might want to gradually move parts of their portfolio away from the dollar. They certainly are more reluctant to buy duration, i.e. the 10-year treasury and longer. And I think some of the uncertainty is chipped away a little bit at the confidence people historically have had in moving into the treasury market. I think we want to watch that carefully and be mindful of it. We've got $36 trillion of debt to sell on a way to 38 trillion and higher. And we want people to be inclined to be in the dollar and to be inclined to be in treasuries. And that's been chipped away at a little bit on the margin over the last few months.
So since Nixon took us off the gold standard in 1971, the only thing backing the dollar has been the faith in the sound management of our currency. And the cornerstone of that has been the independence of the Fed. There have been some questions about that now. I wonder what your thoughts are on that.
I'm still optimistic that that we will maintain the independence of the Fed in terms of setting the Fed funds rate. And I know there has been some uncertainty over the last month or two, but I am very hopeful. I know with Jay Powell at the helm, the Fed will remain politically independent. I'm very hopeful whoever succeeds Jay Powell, I think the Trump administration and that person, whoever they are, I think should share the concern and the desire to be seen as politically independent, not making pre-commitments to the administration about what they will or won't do. And yes, to your point, I do think an independent Fed, as well as a number of other factors, are critical to confidence in the institutional framework in the United States. And that framework is what gives people confidence to be more inclined to buy treasuries, be in the dollar, and make investments in the United States.
Rob, our final question for you. The bottom line, if you were a U.S. business leader right now, what's the one adjustment you'd be making knowing that stagflation might be back on the table?
Yeah, well, I would be doing scenario analysis. Most business leaders are. And what do I mean by that? I think it's very likely case we're going to see growth slow somewhat in 2025, maybe not a recession, but slow, and prices will be stickier. And this is a time I've said many times to be a risk manager, not a prognosticator. If you're trying to make decisions based on predictions, it's going to be a little bit tough. I would encourage you, do scenarios. Don't be in a rush to take action. Be willing to be patient and be a risk manager. And I think that mindset will serve you well over this year and over the next couple of 3 years.
Well, our members appreciate the sound advice. Robert Kaplan, Vice Chairman at Goldman Sachs and former Dallas Fed President, thank you very much for joining us today.
Great to be with you, Jay.
Missed a live episode? Catch the replay on our website, LinkedIn, or on YouTube. You can also listen to the call's podcast edition on Apple, Spotify, or wherever you get your podcasts. Thank you to you, our members, for joining us. This has been The Call, brought to you by the Global Intelligence Desk, asking the right questions to navigate uncertain times.